Based on the latest analyses and institutional predictions for 2026, Bitcoin is on the cusp of its most profound transformation yet. The coming year will not just be about price action, but about Bitcoin's very role in the global financial system changing forever. The breaking of a legendary cycle. Perhaps the most fundamental shift experts see for 2026 is the breaking of Bitcoin's traditional 4-year boom and bust cycle. This historic pattern has defined Bitcoin's life, but analysts from firms like Gemini, Bitwise, and Van Eck argue it's now ending. The reasons are structural. Institutional ownership is cementing. A massive amount of Bitcoin is no longer in the hands of traders, but is locked up in long-term holdings. Over 5% of all Bitcoin is now held on the balance sheets of 172+ public companies, and spot Bitcoin ETFs hold about 7% of the circulating supply. This is patient, sticky capital, not speculative money. Volatility is maturing. Recent market pullbacks have been shallower, around 30%, compared to historical crashes of 75 to 90%. Some even predict Bitcoin could be less volatile than Nvidia stock in 2026. The halving impact is diminishing, with Bitcoin's annual new supply now under 1%, less than gold's inflation rate. Each future halving event cuts a smaller portion of the total supply, reducing its market impact. A geopolitical earthquake, from gold reserves to Bitcoin. The most audacious prediction for 2026 comes from Gemini, which states at least one nation-state could convert part of its gold reserves into Bitcoin. This isn't just speculation, it's a logical next step driven by Bitcoin's advantages over gold: instant transferability, on-chain verifiability, and easy fractionalization. Countries seeking to diversify away from the US dollar or those with high gold to GDP ratios are seen as potential candidates. The great price debate: where could Bitcoin go? With the old cycle broken, price predictions for 2026 are wide-ranging, but cluster around two main narratives. The bullish consensus targets $120,000 to $170,000. Many major institutions see a continued grind-higher market. This view is based on constrained supply from ETFs and long-term holders, coupled with steady institutional demand. Analysts at JPMorgan see a path to $170,000, while Bernstein and Standard Chartered target $150,000. The ultra-bullish case, targets of $200,000 to $250,000 plus. Firms like Fundstrat project a more aggressive surge, betting on a perfect storm of Federal Reserve rate cuts, unprecedented ETF inflows, and no major market shocks. Their target range is $200,000 to $250,000. The bearish warning, targets of $60,000 to $75,000. A cautious camp warns that 2026 could be a dormant year or see a deeper correction. They point to technical analysis suggesting the last bull run may have completed, the risk of ETF outflows, and the potential for tighter global liquidity. Fidelity sees a potential support level between $65,000 and $75,000. Regulation, the final piece of the mainstream puzzle. The regulatory landscape in the United States, reshaped in 2025, will see critical implementation in 2026. The key development is the Genius Act, which created the first federal framework for stablecoins. Rules for issuers on capital, liquidity, and reserves are due by mid-2026 and will determine if stablecoins become the internet's dollar for payments. All eyes are also on Congress, which has a 50-60% chance of passing a sweeping, bipartisan crypto market structure bill in 2026. This law would finally clarify whether a digital asset is a security or a commodity, a fundamental question for the entire industry. The political stakes are high, with both parties expected to actively court crypto voters ahead of the November 2026 midterm elections. The institutional onslaught continues. The institutionalization of crypto will accelerate vertically in 2026. Banks enter the game. Major banks like JPMorgan are preparing to accept Bitcoin as loan collateral and are building crypto trading and settlement products. More crypto unicorns. Successful IPOs in 2025 have reopened the public markets, and record levels of M&A activity are creating full-stack crypto financial giants. New capital floodgates. Analysts predict spot Bitcoin and Ethereum ETFs could purchase more than 100% of all new coins mined in 2026, creating an intense supply squeeze. Furthermore, half of all Ivy League university endowments are predicted to invest in crypto. Key risks to watch in 2026. Despite the bullish structure, real risks remain. Macroeconomic shifts, a return of high inflation forcing central banks to reverse course and raise interest rates, could hurt all risk assets, including Bitcoin. Political and regulatory stumbles. Failure to pass clear market structure laws or a government shutdown could delay progress and create uncertainty. Security breaches. Major exchange hacks or protocol exploits could shatter market confidence, as seen with the $1.4 billion Bybit hot wallet exploit in late 2025. Market mechanics. If a major corporate holder like MicroStrategy were forced to sell, or if passive investment funds decide to exit crypto-heavy companies, it could trigger significant selling pressure. In summary, 2026 is poised to be the year Bitcoin truly grows up. It's a transition from a volatile, retail-driven asset to a mature, institutionally backed pillar of finance, potentially even entering the vaults of nations. The path won't be a straight line up, but the underlying architecture of the market is being fundamentally rewired. Thanks for watching. See you again. Goodbye.